Ladies and gentlemen, welcome to our weekly investor update. My name is Rachel Curlew, AVP of Investment Banking, and I'll be your host today. On today's agenda, we'll be discussing Wigton Wind Farm Limited and Fesco. I'm joined by Junior Roberts, investment advisor and co-host on the channel. Welcome, Junior.
Thanks, Rachel. Happy to be here.
Don't forget to subscribe if you like the content. Also, hit the bell to stay up to date with the channel. We upload content like this once a week. Also, if you want to embark on your first investment journey, you should take that first step with Mayberry. Follow us on social media and get started today. So, now let's get started with Wigton. Well, just a recap, Wigton is the oldest and largest renewable company in Jamaica. They own and operate a 62 megawatt wind energy generation facility in Manchester, which supplies electricity to JPS and by extension the national grid. Also, a little disclaimer, Mayberry is the largest shareholder. We own about 10% stake in the company. Again, it's the oldest and largest renewable company in Jamaica. We are, however, seeing where the stock is trading at 74 cents with a corresponding PE of 63 times. This is definitely above the main market PE of 9 times, so let's see what's driving this. For the 3 months ended June 30, 2023, Wigton reported a 38% decline in revenues to $491 million, down from $494 million the prior year. This resulted from a 39% decline in production, mainly due to a fall-off in wind generation. Cost of sales went up 16% to close the quarter at $238 million. Other income improved by $137 million to $128 million, driven by increases in interest income and FX gains. General expenses increased 12%, which resulted in a net profit of $68 million for the 3 months ended, a 73% decline relative to a profit of $249 million for the prior period last year. We are seeing here that due to a volatility in wind, production dipped 38%, which resulted in a 73% reduction in their EPS. At a stock price of 74 cents, this translates to a PE of 63 times. The stock is currently trading richly relative to its earning, but there is one important thing to note here. There's going to be a taxation adjustment. There was a subsequent event note in the audited financial statements which speaks to an adjustment to the corporate tax rate for Wigton from 33.33% to 25%. They did not get approval ahead of the audit, but the approval seems to relate to the 2023 financial year, which ended in May. As such, we're expecting to see a favorable taxation adjustment flowing straight to the bottom line in the next quarter's interim financials to the tune of $300 million by our estimation. Also, in relation to the renewal of their Phase 1 facility, which accounts for about 20.7 megawatts or a third of Wigton's revenue, we understand that the company is at an advanced stage in negotiations with the OUR and JPS. Just a reminder that Wigton has been granted the right to replace this facility and it needs to negotiate a new tariff with the OUR. So once these negotiations are completed, Wigton will have successfully secured a third of its revenues for the next 20 years. But the company is still in a good position despite the fall-off in profit we're seeing here. Their balance sheet remains robust with an asset base of $10 billion and shareholders' equity amounting to $4.5 billion. They also saw a 2% reduction in liabilities to amount to $6.1 billion as of June. If we look at the next slide, we are expecting Q1 profits to be lower relative to Q1 last year. We have acknowledged that their production capacity was cut by almost 40% due to the volatility in wind, but outside of that, the company still has room for growth. There is currently a 100 megawatt RFP out, and the company should submit their bids by February of next year. Wigton has over 4 billion cash on its balance sheet, so it remains a force to be reckoned with in that competitive bid process. While the RFP is for 100 megawatts, it's our understanding that no single entity can be awarded more than 50 megawatts coming out of this tender process. But Wigton's capacity is currently at 62 megawatts, so if they should win this bid, that will easily increase their capacity by more than 50%, and we can do the math here. So all things considered, the company is in a good position. The government is aiming to reach 50% renewables by 2023. This would mean the country would have to tender more than 300 megawatts of renewable energies over the next 7 years. And with Wigton's experience and knowledge in the market, they're definitely positioned to win some of these bids. And just something else to know, management made it clear that they'll be bidding on multiple sources of renewable energy, not just wind. So Wigton is actually in a great position to double its capacity over the next 5 to 10 years. Looking at the final slide, again, the stock is trading today at 74 cents at a PE of 63 times. But let's not forget the taxation adjustment we're expecting in the upcoming quarter, which will flow straight to the bottom line. And we'll thus see an improvement in the PE and the high PE that we're observing. And just overall, Wigton's medium to long-term growth looks promising. So it's a hold for me. Junior, what are your thoughts?
Great overview, Rachel. I'm definitely excited about Wigton. I continue to buy Wigton for myself and for clients. They show great long-term prospects as a company in the renewable energy space, and definitely looking forward to what the company has in store.
Thanks for that. Now let's move on to Fesco. Over to you.
Thanks, Rach. So for first-time viewers, Fesco, the acronym for Future Energy Source Company Limited. Fesco is known mostly for their retail petroleum outlets, gas stations across the island. We're currently at over 20 locations island-wide, with about 9 in the Kingston and St. Andrew region, right? So to bring to you their 3-month end results as of June 30, this is their best quarter yet. So Fesco boasts revenues of $6.56 billion, year over year compared to June 2022, a 2% increase from $6.4 billion, right? Their operating profits had a 34% increase to $202 million and a net profit with a 4% increase of $158 million. Fesco also had an increase in their total liabilities of 28%, and we'll attribute that to the growth and the expansion. This year they opened an additional 3 locations. So to look at the numbers, they boast revenues of $6.5 billion compared to last year's $6.4 billion, which is a 2% increase. Operating expenses also had a 110% increase. The operating profits were up 34%, now at $202 million as opposed to $151 million last year. Their net profits had a 4% increase of $158 million from $151 million last year. Total liabilities also increased by 28%, right? So currently at $2.8 billion from last year's $2.2 billion. So onto their quarterly movements. As you can see on the graph here, this is their best quarterly performance at a whopping $158 million. Now, bear in mind, Fesco listed in 2021. So seeing this profit movement with the highs and lows coming out of the pandemic, you can see great prospects for their future earnings. So the stock market analysis, Fesco currently trades at $3.35 at a PE ratio of 14 times. Now for perspective, the junior market is trading at 16 times, so it's definitely discounted and on the market as a good buy for you to add to your portfolio. You can see, based on the graph, that the 52-week low for Fesco is $3 per share. So we're still trading above that low. So onto the market analysis. Fesco currently trades at $3.35 per share with a PE of 14 times. So for perspective, the junior market is now at 16 times, which indicates that Fesco is trading at a discount and it's a great buy for your portfolio. Their 52-week high is $5.75 and 52 weeks at $3. So we're still trading above the 52-week low and definitely should be a grab for you. Fesco listed in 2021 at 83 cents per share. So for those who would have bought into Fesco at IPO, they are seeing multiple times increase on their portfolio and they continue to be consistent in their dividend payments. That concludes my analysis of Fesco. Rachel, over to you. What are your thoughts on Fesco?
Thanks, Junior. This company has demonstrated tremendous growth over the last 5 years. They have increased revenues by 48% and profits by 67% to $26 billion and $571 million respectively, which reflects both organic growth and growth through diversification of their products and offerings and services. They are now in the LPG business. They sold their first liter of LPG product, Fesco, in April of this year. They acquired the assets of Wilson Beck, including its LPG plant facility. Yeah, so they're doing a lot of things right now. And as you mentioned, they opened their 19th gas station in July. They opened another one in August, and they're aiming to open the 21st.
This month.
And they're aiming to open the 21st gas station in October. So I believe they'll be on track. And so as of October, they'll have 21 gas stations open. So this company is definitely poised for growth. And I have no doubt that it's going to be trading back up to $6 in the medium term. So it's so I have good hopes for this company.
Yeah, definitely a buy.
And that's it for today's discussion, viewers. Special thank you for tuning in. We could not do this without your support. Julia, thanks as always for sharing your insights on the panel. If you're curious about updates on our virtual investor forum, then find us on social media. We share our live stream dates and upcoming guests on our official social media pages. Give us a follow and stay on top of all things forum related. Also, don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click the bell to receive all notifications. Keep safe and remember, wise investors, slow and steady wins the race. Thank you.